Is there a bull case for oil? Hi, everyone. Welcome to the Market House. I'm Maggie Lake, and today I'm talking markets with Josh Young, the CIO of Bison Interests and author of Bison Insights on Substack. Hi, Josh. Welcome to the Market House.
Thanks for having me.
I'm so excited to have you. And hey to everybody who is joining us live on Substack and YouTube. As always, put your questions in the comments and we'll get to as many as we can. Just a quick check of market action before we jump in. Interestingly, oil prices down about 3% today, with a lot of investors focused on the supply side of the story. And we'll get your thoughts on that in just a couple of minutes, Josh. But we did see stocks trade higher. NASDAQ leading the way again. And this is despite the fact that we are kind of waiting for a government shutdown. Bond yields pulling back a little bit. Will we, won't we get government data? Who knows? That's going to be a big question. But Josh, just like to jump in with that. It's not this government shutdown. We kind of, we've all been to this rodeo before. It's not usually a market event because everyone figures it gets resolved. Any reason to think this is anything different this time? Are you concerned at all about this?
Well, I think every time it sort of ends up as like a mini market event, and everyone's always feeling threatened that it's going to be bigger. And, so far, I can't remember the exact number, but I think it's been over a dozen of these threatened over the last decade plus. So I think so far they haven't really been material, but there's always a risk that there's going to be a down 2 or 3% type day, which ironically we're having already for oil. So maybe this oil downturn for the day is a prelude to that.
Yeah, exactly. And we'll talk a little bit about why that's happening. But are you broadly constructive on U.S. equities, or are you sort of, do you fall into the camp of being a little bit worried where valuations are? That oil is energy aside, which we'll get to, but just generally, sort of how do you approach this?
I've been learning as I get older more and more to try to have strong views on fewer things. So generally the stock market looks a little expensive, but it also could look a lot more expensive if it goes up a lot more.
Yeah.
So I don't know is my fair, I think, response to that.
Yeah. Fair enough. It's been hard. Like nobody wants to short this thing, right? Even if you have feelings that things are a little overextended, but you are definitely looking for opportunity in a place that many have sort of thrown up their hands on, which is why we were so interested to catch up with you. And I know you consider yourself a little bit of a contrarian, at least when it comes to this. So why do you feel that there's better or there is opportunity in energy right now? What are you looking at there?
Yeah, so I think there's sort of the very long-term perspective. We were chatting a little off camera about sort of what I've been doing in my career. And we launched Bison in 2015 with the theory that with less oil exploration, eventually we'd get back into an oil upcycle. And it's taken a decade where I thought it would take 3 years. So I guess that goes to show my crystal ball is definitely broken. But the longer it takes to get back into an oil bull market and get into longer term oil exploration and delineation, the more likely it is that we get into a multi-year shortage. And we saw it in the early to mid 2000s, and we saw it in the 1970s, and we saw it in prior periods. And I think we're setting up for that sort of disappointment from an oil supply perspective. So that has me structurally bullish oil, or I guess long-term cyclically bullish oil here because of that long-term underinvestment. And then shorter term, we're starting to see things like shale start to peak out from a productivity perspective on a per foot basis, both for oil and natural gas. And we're seeing some really interesting things in terms of oil demand and natural gas demand with AI data centers and various other demand drivers where I think the consensus had been too pessimistic. So I think we're sort of meeting the very long-term trend of underinvestment with the shorter-term positive demand surprises. And I think we're seeing that where the consensus had us at, let's say, $45 oil here or soon, and enormous surpluses, seeing a relatively balanced market and oil $20 plus higher, even in the face of some sort of negative news. I think it's promising for what we're going to see, let's say, in the next couple of years.
Yeah, interesting. So what do you make of this OPEC? We have an OPEC meeting, and I think part of what was driving oil prices down today is this idea that, OPEC is going to commit to increasing output. That's part of what's been pressuring oil. Do you buy that? Do you think that investors are overly focused on the impact from OPEC?
Well, I think investors are appropriately focused on OPEC in the sense that OPEC does control most of the remaining spare capacity globally.
Hmm.
Um, I just think we're headed towards this world. It was funny. I sort of tweeted something about this a few months ago just to see sort of what the market reaction or sort of the social media reaction would be about how we would get to one day OPEC increasing their supply quotas and actually the oil price going up and not down. And that would be sort of a trigger of a new oil bull market. And we
Hmm.
actually saw that the last time OPEC increased their quotas. Within 2 or 3 days, you actually saw oil higher than it was before they made their announcement. And so I think the reason that's happening and the reason it matters so much what's happening with OPEC is that because they're the last, for the most part, spare capacity OPEC plus in the world, as they bring back their oil to market, it raises the question of where will the incremental supply come from once OPEC supplies are fully back on the market.
Hmm.
And that raises the question of what's the marginal cost of supply if you need it soon. And I think that question is way higher than the current price. And that's one of the reasons I've been willing to hang around the hoop so long, underperforming versus the market, massively outperforming versus other sort of the broader oil and gas stock indexes. It's worth it to me because I think when we get to that question and we start to get the answer, I think the answer is going to shock people in terms of how high the price is. And then I think you're going to see something similar to what we saw with these gold mining stocks recently or certain other out of
Hmm.
favor sectors that have come back into favor. I think you could just see radical moves, multi 100% moves, especially in some of the small caps, as the oil price has to move higher to signal near-term investment to make up for shortfalls. And again, will that happen this year? Probably not, but maybe. Will it happen next year? More likely, or the year after, even more likely, and so on if it hasn't already happened.
You said something really important just a moment ago, which is that you think there's been this sort of years of underinvestment in the industry. Can you talk to me a little bit more about that? Because I think there's even a question of how much supply we really have, right? I mean, there's some who doubt the sort of immediate supply that OPEC would be able to bring to market.
Well, I'm in that camp. I'm not sure how much they can bring, but they almost definitely can't bring as much as they claim. And
Mm.
I actually think they don't think they can, both from meeting with them earlier this year with the folks running OPEC, the organization, as well as from some of the comments from some of the, let's say, expert consultants and representatives and so on from certain OPEC members. It appears one of the reasons they're raising their quotas so fast and by so much is to try to embarrass certain, well, either embarrass certain other OPEC plus members in retribution for certain, non-compliance previously, or just to sort of position well for future negotiations for quotas to readjust based on actual spare capacity or actual production capacity generally versus claimed capacity. I mean, one of the most ludicrous things in the world in economic figures globally is the number of barrels claimed in reserves by OPEC and OPEC plus members that in many cases have been static for 30 years or 40 years. I mean, it's like Soviet era reporting, except even they would adjust their numbers slightly up and down. And these numbers are just flat and there's no exploration to support it, or almost no exploration. And it's one of those things where it should fall absent new activity by the amount that there's been produced, and that hasn't happened. So I think everyone knows it's less to some extent, and it's just a question of how much less.
Yeah. And we're talking about an industry where when you're talking about investment, there's a long lead time, isn't there? I mean, this is not, or has that changed because of shale and some other factors?
Yeah, I mean, that's the other really important point on this, which is that there's been a lot of investment over the last decade. So I think a lot of the pushback I would get on the claim that there's been underinvestment is looking at just total dollars spent. The problem is that a lot of that investment has been on development of short cycle, high decline shale production in reserves that were mostly already discovered and in some
Mhm.
cases already delineated a decade ago. And there's been way too little investment on the exploration and the sort of conventional delineation globally. And so it's sort of like saying, hey, it's not cold inside because we're burning the furniture. And well, yeah, it's not cold, but also you're just, you're
We're
bringing
burning
forward
the
a problem, and
furniture.
you're actually, exactly, you're literally, so I think they're doing that. So that's why it matters so much, and that's where people, like, they'll use these numbers, but in many cases you see these bull bear debate type things, or really just talking past each other. They just won't be using the same figures. And when you look at the exploration activity, and then more importantly, forget the dollars spent, you look at the number of barrels discovered every year versus the number of barrels produced. And I think the last number I saw was about 12% of the global production was discovered in the last year. And so, I mean, just the replacement ratio versus global reserves is very, very low. And yeah, that can go on for a while, but it's only so long until you start to have real issues, absent demand destruction and demand declines, which again is another important thing. Recently, the IEA, which had these scenarios that were all pessimistic, all forecasting that demand would fall, starting to include scenarios where demand will actually rise, which is what we experience in the real world.
Yeah, I want to dig into that. I want to get this question first. I think this is kind of connected to the investment part we were just talking about from Doug, who says, "Hi, Josh. There's been a turnaround in both oil and gas rig count. Is this a bullish or bearish sign?" Great question, Doug.
Yeah, it's a great question. Honestly, like the very short term numbers for those rig counts are not very reliable.
Mm,
And so I would wait for, let's say, a trailing 4 week or trailing 8 week type average before calling a bottom. I actually own a number of shares in drilling rig equities. And so I would love if the drilling rig count rose, even if it was net slightly bearish for the price for oil or natural gas. But unfortunately, there's not a lot of signs. The overall combined oil and natural gas rig count in North America may have bottomed because the gas rig count has started to rise to offset some of the decline in oil rigs. But to call the bottom, especially on the oil rig count, I think would be tough absent substantially more data and some time.
mm. Uh, Fantastic. I mean, this is why I love talking to somebody who really understands the sector, because you kind of get that nuance, that, when you're seeing these headlines fly, it's not always sort of, the rest of us aren't really sure, what's reliable. So what on the demand side makes you confident that we may be in the beginning of what sounds like you're saying a super cycle, but those are my words, not your words. So correct me if I'm wrong.
Yeah, no, I like the super cycle. I actually like the super cycle more because the folks who were touting the super cycle and who I think did phenomenal work at the JP Morgans and Goldmans of the world have capitulated on it. And if you look at the history of these things, generally the work is done by brilliant, capable people who have enormous teams and all these research efforts. And then generally they do what they're doing right now, which is they give up because the short-term trends go against them and various small things happen, relatively speaking. In some cases, the main people whose idea it was get poached away and go work at
Mm.
big private equity funds or other stuff. And so we're left with beautiful, essentially it becomes open source work at some point. They'll have it on like JP Morgan's website or whatever. But they've given up on it, and you just like pull forward the numbers a couple years and you end up finding that it ends up matching almost perfectly with what ends up actually happening for the most part. So
Mm.
yeah, I think super cycle. And sorry, what was the follow-on
Is it
question?
driven, like, what is the demand? We talked about the supply sort of not being there, underinvestment, maybe OPEC not having as much as everyone assumes that they do, or they claim to have. What about the demand side? What's so compelling on the demand side?
So one of the big things I got wrong coming out of COVID was that the U.S. reopening for COVID, end of 2020, early 21, drove a lot of U.S. oil demand. People were excited to get back out there, excited to get back on planes, excited to drive again. And I thought there was going to be an echo in China, where they were also reopening intermittently. And China ended up actually re-shutting down their economy, re-shutting down for COVID, and then never really their economy never really taking off in the way that people expected. And there's a lot of stories around Chinese electric vehicle demand and so on, but there's a very high correlation between Chinese economic growth and Chinese oil consumption that's held even with the EV adoption that they've reported recently. And so my favorite go-to on China is the China Beige Book, which might be a good interview in the future to go catch one of those guys. But they're out there beating the drum that China is growing again and that signs are good in China. And they called this better than I did a few years ago. So that's a good spot to look for, I think, as sort of a specific potential large demand driver for oil. But broadly, what we've seen is that regardless of the alternative energy narrative, electric vehicle narrative, and so on, in a normal global market, you see global oil demand rise by about 1% a year on average. And you'll see periods of economic booms or emerging market booms, or maybe it grows 2%. And you'll see, terrible periods where maybe it grows 0.5% or 0.8%. But you have sort of this longer run average over the last 40 plus years where we've seen that 1% plus demand growth outside of COVID, with the world being forced to shut down by governments. So it seems like that's going to continue. And I think we have some potential embedded extra demand growth for China now that they're coming out of what looks like has been a multi-year pretty bad economic recession.
It's interesting because we have also had multiple guests on who've been talking about the opportunity in China and the growth they see, but it's been bullish Chinese equities, but you haven't heard the other side of that, which is, with that bullish Chinese economy comes demand for energy. So it doesn't seem like it's, they've been, that narrative has jumped over to the energy side. Jim K just said, I didn't know there were any oil bulls left. Exactly, Jim. That's what we're talking about. And why we said that Josh is a contrarian for now. It strikes me the other theme that was really relevant a few years ago, but also everyone seems to have thrown the towel in, is geopolitics. Do you think does that factor into your thinking? And are investors overly complacent about the threat of conflict that might disrupt supply?
Well, we're actually seeing supply disruptions right now. Ukraine's been bombing Russian oil refineries and export facilities and processing facilities, and it looks like it's impacted roughly a few 100,000 barrels a day of export capacity so far, net effectively, because they can't use some of the refined product pipes to be able to transport some of their oil, and then some of those grades need specific specialized refineries to be able to process them. So there's a small disruption right now. I think the right way to think about oil geopolitical risk is that on average, you'll have somewhere in the 2 to 3 million barrels a day of oil export capacity that's essentially offline for one reason or another. And that can flex up to, I think, closer to 5 or 6 in really extreme periods and down to maybe 1 or so in really loose periods. And right now, we're towards the bottom end of that range. And so I think that means that there is a lot of oil geopolitical risk. The reason I'd frame it like that is, one, I think it's likely that we have less oil on the market from geopolitical, let's say, hotspots or sensitive areas at any given point in the future than we have right now, just because of the historical pattern over a many, multi-year period. But also, people, I think, misconstrue some of the prior oil bull markets and allocate too much credit to, they'll give too much credit, frankly, to OPEC for the 1970s for oil prices rising a lot, where there was a real supply problem in the US, for example, which had been the incremental supply for oil in the 1960s. And we raised the rig count in the US, but we didn't actually raise production much. And we actually started to see the production decline despite a higher rig count in the 1970s, similar in certain other geographies. So I think it's easy to point to that and say, hey, oil went up a lot in the 1970s because of OPEC, and really hard to say, hey, there was all this complicated stuff that was going on, and then this happened and the price rose. And what people forget to say is, oh, and like the oil was back on in 6 weeks, but the price was still 3 times higher, and it stayed there for plus or minus for the next 7 years. So I think that's the right way to think about it. It's a nice starting point for understanding it could be a catalyst, but it's not the whole show. It's just, I think, one aspect of it.
One of the other reasons I think some folks got scared out of this oil trade is that, we had President Trump saying he wants lower oil prices. And we've seen the Trump administration pretty much getting what they want so far. It's early days. Obviously, we're not even through the first year yet. But is that a concern that there will, if even if the market and there are structural reasons for oil to go up, there will be a political hand that will look to sort of tap down those prices?
So the one thing that would make me way less bullish oil in the short to medium term would be if the Trump administration did with oil producers what they've been doing with lithium and certain rare earth metals, where they came in and just gave money to oil producers and gas producers to drill a bunch more wells.
Mm.
And as ridiculous as that sounds, they're literally doing that with some of these others, and they're giving an offtake price. I think for MP, they're doing it for twice the prior market price. I think for one of the lithium companies, they don't have the agreement fully announced, but the rumor is they're going to give them 2x. So if an oil producer can go get $140 a barrel and federal money to go drill, they're going to go drill more, and there's a lot more oil to produce at $140 oil net effectively to that producer, which could negatively affect the market. The good news is for my oil drilling rig stocks, that would be phenomenal. It would be like the best thing possible. So I'm trying to hedge for that a little within sort of my mandate and within my world. And then if you happen to own some of those producers that get the golden wand from the government to whatever, then that would be good too. That would be the biggest risk I could see. And even that would just accelerate the depletion of these reserves that are already being depleted. And I think maybe it would push things off by a year or two for a major sort of oil super cycle, but then it would just be even more extreme. Like the longer it takes for sufficient global exploration and delineation efforts to kick off, the more of a supply problem there's going to be, and the higher the prices are going to need to go to be able to balance the market. You're really just going to need the price to go so high that it destroys demand, which I think is part of why OPEC has been doing what they're doing, which is to try to adequately supply the market, try to get it to sort of a balance where people can feel comfortable with this delineation of exploration. And unfortunately, I think they've been unsuccessful with that. And, so a Trump effort could suppress the price for a period of time more, but then I think would push prices higher. And it would also be just an absolute bonanza for these drilling rig stocks.
Yeah, that's a great way to think about it. And it is a sort of complex, or lots of different options, and we have some questions about where you're looking. But oil prices. So do you have a forecast of where you expect oil prices to go? Because you brought up a really good point. If they spike too high too fast, it kills demand. So it's always that sweet spot that producers are looking for, right? They tend not to want to see it overly high. So where do you think oil prices are going?
So my short-term crystal ball is broken, and every time I try to come up with, hey, it should be this, I don't know. So I guess I have three ways to answer that. So one is that based on current inventory balances and net of the SPR releases and then SPR builds recently, the fair price for WTI oil right now is probably $80 to $85 or so a barrel. And that's not inclusive of the net the net effects of inflation over a long period of time or anything else. Just sort of, if you take today's market and you say, hey, you took away the concern that Trump's going to go try to flood the market or try to, induce barrels or forego sanctions enforcement on Iran or whatever, 80, 85, I think seems fair for right now, just in the current market conditions. Maybe it would go down $5 or $10 a barrel as you get into the winter and as you probably get into a seasonal inventory build, and then maybe you get even higher next summer. I think the price you need in order to solve this global exploration and delineation problem is well in excess of $100 a barrel, and I just don't know when that will happen. And I think there's a risk that you end up with a way higher price if you have some sort of problem in the future, whether it's geopolitical or whether it's purely demand driven or supply disappointment driven. But any of those could drive the price way higher than that, let's say 100, 110 that you need to kick off the exploration that you need to solve the problem. So those are sort of the different ways I would frame it.
Yeah, that's a great way to put it. And you're describing, a sort of structural system that's underinvested. And so you can imagine if you get what we would consider, right, a sort of exogenous shock, whether it's geopolitical or whether it's sort of storming GDP numbers or something from China growing much more strongly, or the global economy for that matter, then all of a sudden you have this buildup of pressures on a system that just doesn't have the supply to meet it. So fantastic question from J&J. Does Josh have views on the best/worst areas of the oil and gas equities right now? Does he prefer producers or services, for example?
So I don't know that I have particular favorite children at the moment in oil and gas. I like the smaller companies because there tend to be bigger mispricings, but there also tends to be more risk. I think the areas I find least interesting here are some of the highest valuation integrated producers because they seem to have deviated substantially from their sort of primary historical business model. Like what got Exxon and Chevron and so on to where they are now, to where they were some of the most profitable businesses in the world, is not what took them from that to the businesses they're at now, where every few years they take 10 or 20 billion dollar write downs, and they have bloated staffs and sort of massive malinvestment and flip and flop back and forth between ESG and non-ESG and whatever. So anyway, those things I like least, I think partly because they're lost and have enormous bureaucratic bloat, but then also they have really, really high valuations. And so to me, those are super uninteresting. They may continue to do fine because they're big parts of the market indexes and they're big parts of the energy indexes when people go buy like an XLE ETF or something like that. So I think the small producers and services companies that are making lots of money in this environment that are well positioned for an upcycle are exciting to me, and those big integrateds I think are particularly unexciting.
Yeah, I just want to share a comment that Endry is making, asking what would it mean for oil and gas prices if we actually had full-on conflict in Europe. Part of the reason that they're asking is because of some things that have been going on in Europe. I mean, there's so many headlines, it's hard to keep across them. They're mentioning drones in Danish airspace. You know that I always recommend Crypto is Macro Now by Noelle Atchison. If you would like to get a rundown on some of the geopolitical tensions that she's been watching and has been concerned about, she just wrote about it today. Go check out her Substack. She kind of gives a great rundown on all of these little hot spots that make you wonder, are we too complacent about geopolitical risks? So it's a great read if you have not done so already, everyone. JMI asking, what's the opinion on mainland drilling for oil and gas, or main game? Will it be offshore, or will the main game be offshore?
I think offshore and onshore I think you need to see a lot more of both. The global exploration probably needs to be more offshore than onshore, just because that's where there are sort of these larger fields that could sort of help offset declines in shale, which will eventually happen in the future, as well as declines in sort of some of the giant and super giant fields in OPEC and elsewhere. My challenge in investing in those is that there's always the risk of the next Macondo. And then there's also there's such a glut still in the offshore drill ships and jackup rigs and so on, and it's so expensive to move them from one geography to another. I think for those to really work, you're going to need to actually see higher prices just to get more of those rigs to work at low rates before you get them to work at higher rates. And so that cycle could take a while. There's one or two exceptions in my view, but I like the onshore rigs more, less because I think they can change that much on a percentage basis. I think there's upside for both onshore and offshore, but it's just so much easier to get an incremental onshore rig working, and there's so much less capital required. I think you see a bigger inflection in onshore rig counts at, let's say, $80 oil, whereas maybe you need 90 or 100 to see a similar sort of change in utilization and then day rates. And then also you need to tie up the offshore rigs for longer in order to get them moved and get them working. And so part of the risk with that is, and we saw this in 2022, when we started to get those to work, they went to work and got these longer contracts at lower rates. And so it's great that they're working, but really the rig stocks, their profits are from a combination of higher utilization and higher day rates. And so you really want to be able to get both. And I think there's a risk that you end up having to wait years before you get into a full bull market for offshore drilling.
Mm. Kelly asking, can you talk about nat gas prices? Are you also looking at that sector, Josh? And specifically wondering about the differential in the US price versus Canada and equities. I don't know if you focus on US companies only, if you're also looking at Canadian energy.
Yeah, I do. I was chairman of a Canadian E&P for a couple of years in there, 2017 to 2018. It was interesting. So Canada has a problem. The government is very opposed. So the Trump administration is trying to force prices low, but volumes up. The Canadian government, I'm not sure exactly what they're trying to do, but they definitely want to punish oil and gas producers and not build pipelines to be able to help get their oil and gas out. And so that's mattered more on the natural gas side. The price for AECO, the Western Canadian gas price, the main one for Alberta, was actually negative last I checked. It may have flipped positive in the last day or so, but it was negative on Friday. And so, that's not a great price if you're a Canadian natural gas producer in the spot market. I think there's a lot of potential for the gas market, both in the US and Canada. There's a lot of demand coming for liquefied natural gas to bring gas to Europe and Asia and various other emerging markets. And there's a lot of demand coming for these AI data centers, which we were chatting a little bit about off camera. There's so much demand coming. There's so many of these things being built. A lot of debate over the economics of them, but it seems very likely that once they're built, they're going to run, because the run cost for them is a tiny fraction of the build cost. And the more of these that get announced, the more of them that get built, the higher the structural demand is going to be for natural gas, which seems to be the main fuel source for them. So I think the demand case there is easier to argue, and it's going to grow a lot more than oil demand is going to grow. And the question there is just, how do the producers balance the market? And then, for Canada, are the producers allowed to actually bring their commodities to market? And can they capture any of the economics on that, or does it all go to CO2 taxes and other similar things?
Yes, the tax issue. We often forget to talk about that, but a lot of people trying to get 3 steps ahead and look at that. So as we wrap, Josh, you just gave a really compelling argument for not gas demand, but you're looking at oil because you think specifically some of these smaller companies, because you think that's where the best opportunity is based on valuation. Is that right?
Yeah, I mean, I'll typically own oil and gas stocks. The companies will typically produce both oil and natural gas, so it is necessary to underwrite them to have at least some understanding of both. And yeah, I think the demand growth story for natural gas is better, but the supply growth is much more available at much less of a premium to the current price and to the forward curve price versus oil. So I think natural gas, the forward curve is 4. Maybe we see 450 or 5, which is fair, but we're talking about sort of a 20% type move. I think for oil, you need the price to close to double from here in order to get the long cycle type investment that's necessary to adequately supply the market over the next 5 or so years. So sort of a different type of dynamic, and very different sort of there's lots of people I think who are bullish natural gas here, and there's it's really hard to find another oil bull.
Which is, again, why we love talking about this. Do you, when we talk about something like mining and metals, I always have sort of experts say, like, just watch out once you start to dip into the junior miners, because you really got to know what you're talking about. Are we looking at a similar thing here, where if you're thinking about diversifying, or you want exposure, or this is an area that you think you can, get in early and take advantage of some of the mispricing that you've talked about, you have to be careful where you are on the food chain?
Yeah, I think you have to be really careful. And then, I mean, I just launched the Substack, so that's a good sort of advertisement for that, which is, hey, like, I've spent a decade doing this and I've made plenty of mistakes, but maybe I'll make less than average. I don't know. Past performance is not indicative, but I figured it'd be fun to sort of write these things up and share systematically individual ideas that could benefit from some of these trends. And hopefully I get fewer of them wrong than average, and hopefully they pay off more than average. But yeah, I think the small caps, there's way more divergence in valuations in both directions. There's just a lot of variance, and there's also a lot of variance in outcomes. And so there's a lot more, let's say, potential upside and a lot more potential downside. And so to me, it's way more interesting. It's where I've spent most of my career, focusing on that space, because there's this convexity, two-way convexity, really. Yeah. So yes, I think it's way more promising, but it also requires a lot of work and is clearly a lot more risky.
Yeah. Which is super important to point out. So, great opportunity, but again, this is where you want to think about, if you are a passive person or if you're interested in more active, make sure you're seeking out um folks who have been in the space and know it, because I think it's important sort of to underscore that. I'm going to squeeze one more in from David. How large is the Guyana fields and what will it mean to Exxon?
I mean, the Guyana fields are big. I think the right way to think about them, like many big discoveries, is that they'll end up being bigger than people think, but they'll also take longer to develop and cost a lot more. And then I think there's some complexity there. There's some geopolitical risk in terms of being right next to Venezuela, which has made claims on most of Guyana, as well as there being some geologic risk where
Mm,
some of these fields have had improbably low declines. And that might be good, or it might actually be that they've been choking the wells and that there's maybe not. It's just a little more complicated, I think, than people are claiming. So when Exxon and Chevron fight over something and start sort of name calling almost on TV, the CEOs sort of didn't have great things to say about each other while they were having that conflict. That tells you there's a lot there, right? But I think it's also more complicated. I think it's going to take longer to get the production that the let's say 2029 production. I think maybe will take till 2031 or something to come on, and it's I think going to cost more, but I think you'll ultimately get more. The problem is, so people say, hey, you're wrong about the long-term exploration thesis because of Guyana. And actually, Guyana, I think, is the exception that proves the rule. We need a Guyana every year. Guyana is going to come on eventually with over 1 million barrels a day. Maybe we'll get to two. Okay, so Guyana, the discovery was what, 2014, 2015, that sort of pivotal discovery. And here we are in 2025 talking about maybe getting to 1 million barrels a day and then hopefully a little more. Great. What happened in 2016, 2017, 2018, 2019, et cetera? There's just many sort of gap years that were filled by shale, which was high initial productivity and then very high decline. And there's not those next shale fields to replace the shale declines. So you start needing to look for the conventional fields, and the exploration just wasn't there. And
mm,
where it was there, you have 200,000 barrel a day fields, not 2 million barrel a day fields. So there's this big open question. So it's great to talk about Guyana because it's a success, but then, maybe offshore Namibia, maybe one or two other spots. BP's real excited about high pressure offshore Gulf of Mexico, which, is interesting, brave of them, I guess, to go back, and we'll see. Hopefully this time is better. But you know, I think there's sort of this big open question, and Guyana is just so interesting because you need another one every year, and we've spent a decade not finding the next one. And so I think the next decade is maybe going to be the quest for the next set of Guyanas. And I'm not sure we're going to find them. And so I think that might require a much higher price to be able to find more of the smaller ones.
yeah, and that's the key, because that's what incentivizes that the exploration. Josh, this was such a fascinating conversation. I'm so glad we could sort of take an alternate view and lean in on your expertise in this area, to get us thinking about sort of a little bit further out and away from the pack, maybe. So thank you so much.
Thanks for having me. I appreciate
Appreciate
it.
it. Love that you're on Substack. We're going to drop the link in the description, as we always do, where you can find Josh's Substack and follow him there. And thanks for following us and subscribing. If you have not, please do so. And we look forward to seeing you again on Wednesday. We're going to be with Peter Bookfar, so join us for that. Thanks, everybody. Have a great evening and afternoon, and next morning if you're in Asia. And we'll see you next time. Take care and good luck out there.